Hello everyone, I am Divya Grover, here to help you take informed mutual fund investment decisions. Over 200 equity mutual fund NFOs launched in a single year, and even more lined up for 2026. The real question is, are all these new fund offers actually helping investors or just adding to the confusion? Before you consider investing in the next mutual fund NFO, there are some important things you should know. Back in 2018, SEBI introduced categorization norms for mutual funds. The idea was simple: prevent duplication of schemes and ensure every fund stays true to its investment mandate. This was meant to make fund selection easier and more transparent for investors. But with the rapid pace at which fund houses are launching NFOs, it raises an important question. Is this objective really being met? In 2025 alone, mutual fund houses launched more than 200 equity-oriented schemes. Even newly launched and small-sized fund houses have joined that trend, and many more NFOs are expected in 2026. So let's understand what's really happening. Why are so many NFOs being launched? Fund houses typically launch NFOs during market rallies. Why? Because optimism is high. Investors are entering markets and improving returns drive large inflows. At the same time, fund houses are increasingly focusing on passively managed funds, innovative product structures, since there is no cap on the number of index funds, ETFs, fund of funds, sector thematic funds or closed-ended schemes a fund house can launch. Naturally, these categories have seen the highest number of launches. Many of these are passively managed, meaning there is no pressure on the fund manager to outperform the peers or the benchmark. For fund houses, this becomes an opportunity to gather more AUM. The next is the ₹10 NAV proposition. NFOs definitely offer more choices, but more choices also mean more confusion. One common reason investors are attracted to NFOs is the ₹10 NAV proposition. It creates an impression that the fund is available at a bargain compared to older funds with higher NAVs. But this is not true. Let's understand with a simple example. If you invest ₹5,000 in Fund A with NAV of ₹10, you get 500 units. And Fund B with a NAV of ₹50, you get 100 units. If both funds grow by 25% in 1 year, Fund A NAV becomes ₹12.5 and Fund B NAV becomes 62.5. Your investment value in both cases becomes ₹6,250. So, the returns are identical, irrespective of the NAV. This means you should not fall for the ₹10 NAV proposition. A lower NAV does not mean that the fund is available at a cheaper price. Now coming to the real risk of investing in NFOs. When selecting mutual funds, track record and risk-reward metrics are crucial. But NFOs do not have proven performance history, risk-reward metrics, and reliable portfolio characteristics. So you cannot assess asset allocation, market cap bias, sector exposure, portfolio concentration, and portfolio churn. And if the NFO is from a new fund house, it becomes difficult to evaluate its investment philosophy and process. Remember, only process-driven fund houses that focus on quality and risk management can deliver consistent long-term performance. So when can you consider an NFO? If you are willing to take the risk, you may consider an NFO if it offers a unique proposition not available in the market, or if it helps you diversify your portfolio, it aligns with your risk appetite and time horizon, and if it supports your financial goals. If investing in passively managed schemes, assess its expense ratio, tracking error, trading volumes in case of ETFs, and alignment with your strategic asset allocation. Do you need to add too many NFOs? No. You do not need more than 5 to 10 mutual fund schemes in your portfolio, depending on the size of your investment corpus. These should be spread across equity funds, debt funds, hybrid funds, and ELSs. Too many funds can lead to over-diversification and make portfolio management difficult. Instead of chasing multiple NFOs, follow a goal-based investment approach. Map your investments to specific financial goals like retirement or children's future. Choose categories based on your risk profile and time horizon. If you have a long-term horizon of at least 5 years, your core portfolio should ideally include actively managed equity schemes such as large cap funds, flexi cap funds, and mid cap funds. Select schemes with a long-term track record of reasonable risk-adjusted returns and strong qualitative attributes. And remember, whether it's an NFO or an existing fund, periodic review is essential. Some schemes perform well in the short term, but long-term consistency is what truly matters. In conclusion, NFOs are not inherently good or bad, but they are not automatically opportunities either. If your current portfolio is well diversified and capable of handling markets ups and downs, there is no need to aimlessly add new funds just because they are newly launched. Don't invest because it's new. Don't invest because the NAV is rupees 10. Don't invest because everyone else is. Invest because it fits your goals, your risk profile, and your long-term strategy. In investing, discipline matters more than novelty. For more insights on mutual fund investing, subscribe to the Equitymaster YouTube channel. Happy investing! Mutual fund investments are subject to market risk. Read all scheme-related documents carefully. Registration granted by SEBI, enlistment as RA and IA with exchange, and certification from NISM in no way guarantee performance of the intermediary or provide any assurance of returns to investors. Investment in securities market are subject to market risk. Read all the related documents carefully before investing.